Welcome to the Joe DeLisi Financial Advisor Podcast. I'm Joe DeLisi, and I want to talk about the safety of the stock market today. You're probably listening, well, if you're listening right away, you're listening on the eve of the 2024 presidential election. And now I'm a political guy, so I like to watch it like it's the Super Bowl. I'll stay up at night and I'll watch returns and I'll look at different states. And I've always liked it. I grew up somewhat in Washington, D.C. And so I just became a political animal at a relatively young age. And I enjoy it. It gives me some frustration at times, but I do enjoy watching how this whole thing plays out. And in 2020, I was sitting in the house we lived in at the time, and I was watching returns come in. And I remember earlier on in the night, when it looked like President Trump was going to win re-election, stock markets jumped. And then as the night went on, that changed. And so the stock futures changed. And I was getting email from clients that night, very concerned. And so rather than talk about what I think is going to happen, because who knows, I have no idea what's going to happen in the election, or what's going to happen in the markets short term. Long term, I have a very good idea of what's going to happen in the markets, but short term, I don't know. Rather than get into that, I think on the eve of this presidential election, I'd rather look at just the idea or the concept of, well, is the stock market safe? And the first thing I guess I would say, which wouldn't surprise any of my clients, is which market? Which market are we talking about? Now, we're going to talk about the S&P 500 today. Not because I think that's where you should be invested. It's just because it's a good barometer, right? It's a good catch-all, for lack of a better term. Everyone understands what that is, or they have an idea of what that is. And while you shouldn't be overly invested in the S&P 500, you should be allocated to other factors as well, like small and value, international, et cetera. We're going to use it today just for ease of conversation. And so on this eve of the presidential election, the question is the stock market safe? Well, safety is in the eye of the beholder. I know that's not the saying, but it probably works here. Because really one of the most common things that keeps people from investing in the stock market is this perception of risk. Most of us are going to remember very troubling times in stock markets, such as 2000 to 2002, which we've talked about on this podcast about what that was like, and how people honestly were very overweighted to the S&P back then, and specifically the NASDAQ before significant drops that took the NASDAQ 15 years to even recover. And so on the back of that, if you think about it, those 3 negative years in the S&P 500 from 2000 to 2002, we then had a huge drop in 2008. And that wasn't really a long time, right? From the 20 to 2002. And so these things remain in our memories, our collective memories, and they probably even carry with them very real emotional scars with them. It's scary stuff. However, you have to remember, even in these quote unquote crashes, no one lost all their money in a diversified portfolio. So you may have heard this before. I've used this many times, but investing in the stock market can really feel like air travel. I fly a lot. I don't really like it. I don't like anything about flying. I don't like the airports. I don't like the crowds. I don't like the planes themselves. I don't like the smells. I don't like the feeling of being out of control. And many people have a natural fear over things that they have no control over. And when we're flying, and this, I'm speaking about myself, when I say when we're flying, we hit turbulence, it feels like it's never going to end. You begin to sweat, you assume the worst. But how often have you been killed from turbulence? I mean, never. If you're listening to the podcast, you're obviously not dead. You've never died from turbulence, but that doesn't mean that you're going to actually enjoy the turbulence. And oddly, that comparison in air travel and stock investing, it's really a good one. It's why I keep using it. I've used riptides before, but not everybody swims in the ocean, but everybody's flown. And I don't know anyone who updates their will and their legal documents before traveling by car, but automobile travel is actually significantly more dangerous than air travel. Some of that's because of the amount of auto travel versus air travel. But here's some statistics on it, okay, on traveling. And this is as much for my own mental well-being as yours. The National Safety Council estimates that the lifetime odds of dying in a car accident in the U.S. are about 1 in 101. 1 in 101. The odds of dying in a plane crash are estimated at around 1 in 11 million. So 1 in 101 auto, 1 in 11 million dying in a plane crash. And that's according to the International Air Transportation Association. And yet it's air travel that takes up all the scary space in most of our heads. And it's not to say that there is no danger in flying, but if we look at large chunks of data, we can see that air travel is indeed very safe, relatively very, very safe. And the same can be true in stock market investing. Many people just focus on the turbulence, which is to say they sweat during scary economic times or times when stocks are going down in value. Now, going back to the air travel thing, what's interesting, because I do fly a lot, I have a brother-in-law who is a pilot and has explained to me how planes work and, what turbulence is and all this kind of fun stuff. And so when turbulence gets bad, what I do is I try to sit there and think about there are pilots up there who understand this very well, and they're not parachuting out of this plane. They probably don't think it's any big deal. They probably don't even feel it. And some of that's because they're in the cockpit and they're in control, but other parts of it is because they understand it. They understand the dynamics. They understand the science of air travel and what turbulence is and what it isn't. And in stock markets, I think that same thing happens. Right? Why the sweat when stocks are going down in value? And the answer is because there's no guarantee that stock market investing is going to provide you any return. There's just not. There's no guarantee of that. There's no guarantee I'm going to land in an airplane. But guess what? That's true of everything in life. It's true of your job. It's true of your business. There's no guarantee that your business or your W-2 income job is going to provide 1 cent of revenue to you long term. All you can do is look at your business plan or your contract that you have, if you have one, and there are reams of data that suggest that your occupation will indeed produce a profit for you. But you don't get a guarantee from anyone that you're going to be okay forever. But you feel better because you feel like you're in control, just like a driver of a car feels in control, even though the statistics bear that the driver is actually taking on much more risk than that passenger in the airplane. Now, while we have no guarantee at all of a forever positive outcome of a business, a job, or the stock market, we do have a reasonable set of data that suggests the risk may very well be worth taking. And this is why I don't sweat turbulence in the stock market. And so when you look at me, metaphorically, when the markets are dropping, even if they're dropping quickly and violently, you're going to see I'm calm. I'm very calm. I understand what's happening because this is all I do. This is all I look at. And so with stocks, the probability of a positive return actually very much increases over time. So if we see stock futures change Tuesday night as outcomes of the election become more clear, that's a very short-term situation, whether it's up or down. Over time, we know that positive returns in the stock market it's very likely. So let's follow this along. An investment in the U.S. stock market, again, using the S&P 500 index, grew wealth during 75% of the 1-year time periods between January of 26 and May of 2023. January of 1926 and May of 2023. Put another way, almost 100 years of rolling 1-year returns and 75% chance that in any given year, you're positive. Now, that's a wonderful data point. 75% of the time, you have a positive return over 1 year. Over 10-year time periods, this now occurred not 75% of the time, but 95% of all rolling 10-year time periods of almost 100 years. So we know that if I can keep you in your seat and not jumping out of the plane, if I can keep you in your seat, in your portfolio, over a 10-year, over a decade, your odds of a positive return are 95%. 95%. While positive stock returns are never guaranteed over any horizon, no period exceeding 184 months or about 15 years, no period has seen a negative return in the U.S. Okay, so put another way, there's never been an instance over a little bit more than 15 years have we ever actually been negative in the S&P 500. This is not meant to imply that stocks are less risky in the long run. The range of stock market outcomes over long time periods is vast. I mean, there's a huge range of outcomes. Just statistical analysis is what I'm talking about. But the final value of a dollar invested in U.S. stocks over 1-year periods between January of 1926 and May of 2023 has ranged from so you put $1 in, And 1 year outcome has ranged from your dollar's now worth 32 cents, which is obviously a negative return, to $2.63. Very good, very positive return. That's your range, right? So there's a lot of range there. But over 20 years, so that's a 1 year time period, over 20 years, the gap between worst and best case scenarios was your dollar grew to $1.45 or $28.62. That's a cumulative return difference of thousands of percentage points, right? So the level of difference in outcomes means stocks should not be considered safe over any time horizon because of the turbulence and what the turbulence might cause an investor to do. But disciplined long-term investors whose goal is growing wealth have the odds very much stacked in their favor with a broadly diversified allocation to stocks. So a final note on safety. Your definition is key here. Hence my phrase that safety is in the eye of the beholder. If your definition of safety is simply not losing a deposit of $1, then putting your money in a coffee can is the safest. However, with inflation, that coffee can is probably a very dangerous offer. Inflation will compound your dollar in a negative direction. So just think of the miracle of compound interest, but going the wrong way. And this is one reason why we need to consider being in stocks over a long time. We've got to battle the negative compounding effects of inflation by compounding interest on the positive end in a way that outweighs that inflationary factor. So here's some data on that. Since 1973, the U.S. Consumer Price Index, the CPI, has shown a long-term average annual inflation rate of about 4%, just a little under 4%. And this figure, it's a great figure to use since 73 because it includes periods of very high inflation in the 70s and early 80s and lower inflation rates from the mid 80s through, say, the 2010s. It doesn't sound like much, but that means that an item that cost $1 in 1973 would cost more than $7 today. So if you had $1 in a coffee can in 1973, you'd need $7 in that coffee can just to buy the same stuff. So the coffee can dollar would be almost worthless, not safe at all. Now, the S&P 500 over that same time period, 1973, would have averaged almost 11%. So that dollar, well, that dollar invested in the S&P, that dollar would be worth over $200. So if inflation requires that dollar to be worth $7 just to break even, you've done just fine since your dollar isn't worth $7, but it's worth over $205. So, is the stock market safe? Well, it probably will never feel like it to you because it isn't a linear return. And the prevalence of the news cycle and social media to report how the world is always ending will constantly make you fearful. But as we can see from the data, while there's no guarantee on a return of your dollar, just like your job or your business, there is overwhelming evidence to suggest that long-term investors do very well in stocks, even net of inflation. So that's it for today. Now, again, we've got the presidential election coming up tomorrow, Tuesday. Let's see how it goes. By the next podcast, we may know who is the next president of the United States, or we may not. It just sort of depends, obviously, on how this thing goes. So in all likelihood, we'll be commenting on that and as to what we can expect from markets moving forward. And we'll talk about maybe some different markets as well. Otherwise, if you're going to watch the election, buckle up, enjoy the popcorn, and have a good evening or evenings. And if you're not, God bless you. Just go on with your life, and we'll let you know how it all turns out. Compliance. Registered representative, financial advisor, Park Avenue Securities, LLC, Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-686-6400. Securities products are offered through past member FINRA, SIPC, financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Past is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Past or Guardian. Insurance product offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California, insurance license number 0034103. This podcast is for informational purposes only, is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that their individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or enforced by Past, Guardian, or Westpac Wealth Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. This material is intended for general use by providing the content. Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in any fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged, and one cannot invest directly in an index. 723 37867.1 expires October 2026.